Hi students, welcome again. Today we have started the concept of the break-even point. In the previous lecture, we have discussed that what is the break-even point, what is the concept of the CVP analysis. So we will continue from that point again. So the break-even point is what point where the profit or loss is equal to 0. Means no profit and no loss, where the business is getting not any profit, business is not getting any loss. So in a simple way we can say that the total revenue is equal to total cost. So the total revenue is equal to the total cost. So how we calculate the total revenue, how we calculate the total cost? So the total revenue is simply the sale price per unit multiplied by the number of units they are selling. They may be selling 100 units, they may be selling 1000 units. So whatsoever is the number of units they are selling, so we are multiplying that with the sale price per unit. So it may be $10, it may be $20, it may be $1. Then the number of units will be 1000, 20,000, 50,000. So any number of units which they are selling, if they multiply with the price per unit, so that will be called the total revenue. Now, what is the total cost? Total cost is basically the combination of the two costs, which is the variable cost and the fixed cost. We are talking about only the production cost, the cost for the production, the cost for the administration, so all the things, but we are not segregating with respect to that one. We are considering with respect to what? With respect to the concept where we have a cost, either it is a variable or it is a fixed cost. So it is a variable cost per unit again multiplied by with the number of units and plus if there are any fixed cost. Now what is the difference between the variable cost and what is the fixed cost that we have discussed in the previous lecture? You can see those videos, you can see that content, so you will be able to understand the concept of the fixed cost and the variable cost. We just, from that point, the number of units we just considered as a x, number of the units. So here again it will be x. So this is what, this is how we see that the total revenue is equal to total cost. So from that, what we will get? We will get the break-even point formula. And as we know, break-even point is what point? The number of units the business is selling, and what is the result? The result is there is no profit, there is no loss. They are just recovering all their costs, either it's a fixed cost or the variable cost. So we just continue with that one. So from here, if we just change a little bit, like it is a sale price per unit multiplied by the number of units, and if we just change the position from the right hand side to the left hand side of the equation, so we can say that the variable cost per unit multiplied by x, so it is equal to what? It is equal to the fixed cost, or we can say it as a FC. Now from here, what is common? X is the common variable cost, and then it is equal to what? It is equal to the fixed cost. So x is common here, so we took the common from that one. So we have a sale price per unit and the variable cost per unit, and from that we have just took the common x in the equation. So it is the sale price per unit minus the variable cost per unit. So here x is the common. So if we want to calculate the x, so this will be the fixed cost divided by the sale price per unit minus the variable cost per unit. Now what is meaning by the x? X, as we have already said, that it is the number of the units. So here the number of unit is the x, and this x means what? These are the number of units where the total revenue of the business is equal to total cost of the business. So this is the number of units, or in a simple way, the break-even point units. Break-even point units means they will be selling these number of units. The answer may be 100, 200, 500, 1000, depending on the situation, depending on the values. So these will be the number of units. If they sell these number of units, what they will get the break-even point, where we have a sale revenue will be equal to the total cost. So the company will be in a no profit, no loss situation. So the formula is very simple for the break-even point in the number of units. So that is the fixed cost. The fixed cost, overall cost for that business, divided by the sale price per unit, and then the variable cost. So we have to minus these two, and then we have to calculate. We just assume some of the values. For example, like a fixed cost is, just assume that it is how much? It is a $5,000 is the fixed cost. And if we divide it with the sale price, we just assume any sale price like a $15 minus the variable cost. Let's assume it is $10. So 5,000 divided by 5. So the answer is 1,000 units. So what is meaning of the 1,000 units here? The 1,000 unit is the break-even point. It is what? It is the break-even point. So break-even point in a simple words is what? Where the total revenue of the business is equal to the total cost of the business, where the business is in a no profit, no loss situation. So for any specific company, if they are selling any product on a $15 per unit, and the variable and the fixed cost, they know that the fixed cost is total 5,000 for that specific period, and the variable cost per unit is a $10. So how many units they have to sell to achieve the break-even point? They have to sell at least 1,000 units. If they are selling, they will be in a no profit, no loss situation. So what does mean it a 1,000 units? So let's say that if they are selling 999 units, they are selling 1,000 units, and they are selling 1,001 units. So these are the three options are there. A is there, B is there, and C is there. So according to the current situation, according to the current values, it means if they are selling 1,000 units, the profit or loss, obviously it will be zero. There will be no profit, no loss. The value will be zero. But if they are selling 999 units, means if they are selling even one unit less than 1,000 units, the company has a negative balance, means the company will be in a loss. So they have been suffering a loss. And if they are selling even one extra units, means here the answer will be positive, means the company will be in the profit. So but at that point, exactly at 1,000 units, the company will be in a no profit, no loss situation. This is how we are calculating the break-even point. These are the number of units in the break-even point. So this is very simple way how we are calculating the break-even point. So only the fixed cost we need. The second thing we need is what? Is the variable cost per unit, and third thing we need is what? Is the sale price per unit. From that we can simply get the break-even point in number of units. Obviously there are so many other things that how it is calculated through the graphical method is there. Again, if there is a target profit situation, the contribution margin concepts, there are so many other things we will discuss in the next lecture. Hope you have understood the concept, and still if you have any doubt, if you have any question, you can ask me in the comment section. Thank you very much.